Well, good morning, everybody. Today is Tuesday, March 5th, 2019. I'm Tim Klepper, the managing partner of Ellsworth Advisors. We're a registered investment advisor located here in Hudson, Ohio. And joining me today is Mr. Kelly Keenan. Kelly, good morning.
Tim, thank you.
Kelly is our portfolio manager and also managing director of the firm, and as well, Mr. Cameron Mealy. Cameron, good morning.
Tim, good morning. Good to see you.
Managing director and handles all of our business development and really does all the work with our clients. So we're super excited to kind of get together here this morning, talk through really February and what has gone on inside the portfolios. And to do that is Kelly Keenan. Kelly, good morning.
Thank you, Tim. And it's been a long time since you've been on a
while.
call
It's
with
great
us.
to be back. Yeah, it's great
Good to have you back.
Thank you. Excited.
Our last call was only a couple weeks ago, so we kind of want to get on track. We'll start doing these every first Tuesday of the month, so a little more consistency in the videos. But our last call, things were going pretty well early in the year, and today we're just going to kind of sum up what happened in February and year to date. As usual, start off with the markets themselves. The S&P 500 year to date, pretty strong rebound from the lows back in December. Year to date, the S&P is up about 11.08%. For the month of February, up about 5.32. So, January is good. February just kept on chugging right along.
How much is it up year to date?
Year to date, 1108.
The S&P.
S&P 500. Yeah. The Dow, a little bit better. Dow's up 11.1. For the month, 5.66, so a little stronger month for the Dow.
So a lot of the pain that people felt last year at the end of the year, they've made a lot of that back, if not all of it.
Absolutely. So the lows came in on December 24th. Mm-hmm. The markets rallied back about 20%.
Yeah.
So we're basically at the highs that we saw in December. Okay. And we've kind of hit a little bit of a ceiling where we've gotten around 2,800. This will be the fourth time, and things kind of stall out a little bit. Mm-hmm. The good thing is we're well above the 200-day moving average, which we were having trouble breaking through and staying above. Knock on wood, so far we're about 10 sessions in where we stayed above it. That's good. We still need the 50-day to catch up where we can get into a little more comfortable position that we're back in an uptrend. Besides the U.S., international stocks have lagged. They also recovered. Year to date, the EFA, which is developed world, that's up about 8.94%. For the month, 3.79, so definitely lagging behind the U.S. On the emerging market side, emerging markets up 8.83 for the year, 2.23 for the month of February. So definitely seeing outperformance in the U.S., which makes sense. The U.S. economy is basically driving the world at this point. We have a lot of weakness in Europe. China's been soft, so the U.S. is carrying the water. From a portfolio standpoint, growth with income portfolio, we talked about last time how I've kind of de-risked that, but we still have a decent amount of equity exposure. Year to date, we're up right around 8% for the year. For the month, about 2.5%. So based on the amount of equities we have in there, that's performing the way it should be. Price potential, up about 9% year to date, so that's lagged a little bit. Last month, only up about 2.5%. And really, two positions hurt us. We had some disappointing earnings came in from Bookings Holdings, which was up a lot. So in general, we still made money in that stock, but we basically gave a lot of it back in the last week or so.
Here, these last couple of months.
It was up, and we, like I said, we gave a nice chunk of that back, but we still like the fundamental story there. I mean, they're in a great business, huge margins. They're basically the old price line.
I know, yeah.
Great. So it's good business, and you know what? Hey, it's a one quarter earnings, not a big deal. The other stock that held us back in that portfolio was Car Auction Services, down about 9.4% during the month. So that's definitely drug down the performance just in the month. Once again, fundamentals we still like. We haven't traded out of that. And we kind of have to wait to see how things shape up, but we still like that portfolio or that position in the portfolio for price potential.
Yep.
Dividend yield are basically our yield portfolio, high quality U.S. stocks. Year to date up about 10%, so that's almost pacing with the Dow and the S&P. For the month, 4.3%. Really, everything in there has just kind of been chugging along. Coca-Cola down about 5%, a little bit of a pullback for the month, so that drug us down a little bit. Those numbers probably would have been a little bit stronger. Really where, the portfolio that's ripped so far year to date is the small cap portfolio.
Ripped being good.
Being good, yeah.
Okay.
Up about six.
Not ripped up, but ripped up.
Ripped up.
Yeah, ripped going well.
Yes.
Got it. Yeah.
Up about 16%. So last year, small caps were strong for us. And things kind of slowed down at the end of the year. They gave back a lot of their gains last year, but year to date up about 16, off to a strong start. Last month, 7.2%. So things are moving in that small cap portfolio. So we've had some good movers in there, and as usual, it's always going to be volatile. So that's kind of where we're at. Things kind of performing the way we would expect.
Well, good
With
job.
a quality bias. And I think kick it over to Cam with some of the economic highlights.
Yeah, thanks. Cameron, economic highlights.
Thanks, Kelly. Thanks, Tim. And for all of our clients out there, we have a very special birthday to announce. No, it is not Tim Klepper's 44th birthday, which happened yesterday.
Yeah.
Happy birthday, Tim.
Thanks, Cameron.
Last week marked the 10th birthday of the current bull market. And so what's on everybody's mind is how long can this bull market last?
10 years, wow.
And when you look at a 10-year bull market, you are talking about a historic bull market for the U.S. economy. But an interesting fact is Australia is currently in their 25th year of a bull market. So just because a bull market goes on for a while doesn't mean it has to end. That being said, we are cautiously optimistic that the U.S. economy continues to be strong. Most of you have seen the headline, but GDP for the fourth quarter was at 2.6% annual rate. That is below President Trump's goal of 3%. But economists also say that about 30 basis points, there's about a 30 basis point loss in GDP because of the government shutdown in the fourth quarter. So you add that 30 basis points in, you're right there at 2.9%. That's very strong growth for an economy as large as ours. The U.S. economy today is $20 trillion. That's 31% of the world economy. So law of large numbers say moving a big old economy like that is not easy. So, growth above 2%.
That's a big economy.
Growth above 2%.
And we're happy to be here.
And we're happy to be here. Is a very, very strong growth rate. Now, we do expect to see some slowdown. The Fed is seeing slowdown. All of the major economic indicators are seeing a bit of a slowdown. For example, the consensus for real GDP in 2019 is to slow from approximately 2.9% adjusted for that government shutdown in 2018 to 2.7% in 2019, then to slow to a further 2.2% in 2020. So all of the indicators definitely say that the U.S. economy is slowing. It still remains extremely strong, but we've got a lot of political uncertainty, a lot of labor shortages, mounting debt, and certainly a significant slowdown in both Europe and Asia. I think what's interesting to see is that China yesterday announced that they're implementing a new stimulus package. And for anybody who keeps track of international markets, you'll remember even 2 years ago, the Chinese economy was growing at 10% per year. They're now expecting growth of 6 to 6.5%. So this protracted trade war with the U.S. has definitely had a significant hampering of the Chinese economy. And I think, frankly, they've realized that where they thought that they were the world's manufacturer, they need a partner to buy all those goods. And so I think the Chinese have definitely learned that getting into a trade, I don't want to say pissing match, but pissing match with the U.S. is not a great idea. And so we do expect for there to be some sort of trade resolution. It might come this week, it might come next week, but the strong consensus is that we will come to a trade understanding with the Chinese. That could probably lead to some short-term growth in U.S. stocks, which would be a great thing. But we definitely see the U.S. economy slowing down, which is why Kelly continues to look for value for companies with great balance sheets, strong cash flow. We really do stay away from the high flyers, the companies that are going to be hurt when things slow down and when the economy does finally move into a position of pullback. Just given that slowdown in the economy, that's kind of underscored by the Fed and interest rate policy. Fed Chairman Powell testified before both sessions of Congress last week, and the consensus really is now that there will be no interest rate increases in 2019. 6 months ago, we were looking at maybe 100 basis points, 25 basis point increases. It looks like today there will be no increases in the federal funds interest rate, and the consensus is for only 25 basis point increase in 2020. So that definitely tells you two things. The Fed's worried about the slowing economy, and they also still don't see inflation to be much of a risk. So they've taken a very dovish approach. I think for the first time as chairman, Chairman Powell's indicated that they really are on kind of a month-to-month wait-and-see approach to how the economy is responding to what the Fed actions are going to be and the wind down of the Fed balance sheet. So with that, I think our hallmark at Ellsworth continues to be quality and value. And with quality and value, you're going to have the best of both worlds in terms of high quality companies. They're going to fare very well in an up economy, and they're going to fare better than most companies in a down economy. So quality and value, a little bit more of a move towards value versus growth is kind of where we're at today, and we'll do quite well, we believe, in a slowing economy.
Yeah.
So we're quite happy with where the portfolios are at. Kelly continues to do a great job, and as always, if any of our trusted clients have questions, we're here to answer them.
Yeah, great. Well, thanks, Cameron. And it's quality and value. I mean, that's the hallmark of Ellsworth. We are not day traders. We're not looking to trade portfolios for folks. We manage long-term assets for people, and we manage a lot of them. So we're super excited to have that. So, Kelly, you've done a great job kind of navigating this, not only through the last couple of months here, through the down market at the end of last year, but into this year. What would you say would be your biggest surprise here going into 2019?
The biggest surprise was the weakness in December. Mm-hmm. The bounce back has been very encouraging. As we started coming out of it, breaking through the 200-day moving average, getting up there, that gives me some comfort. Reassurance that we probably haven't seen the highs of the market for the cycle, which we saw back in September. I think we'll revisit those highs at some point, put in some new highs, and surprise-wise, we've had some good movers. Growth with income, we're more in the I guess, conservative value-oriented stocks, but, just last month, Honeywell was up 7%, Cisco up 9.5%, Microchip up 9%, Visa up 9%. So, some of our core holdings are performing well in there.
Well, yeah.
Motorola and the price potential up 22% in a month. We haven't held that for very long, so we made some nice money there. Dividend yield, Boeing up 14% year to date. Just for the month up 14%. Yeah. Intel up 13%. Those are the things working. Small cap, we have some high flyers in there. This Tandem Diabetes Care up 49%, not bad. Etsy, which we've had for probably less than a year, I think we've tripled our money. That was up 20% 30% last month, and BioLife up 29%. So we have some big winners in there, but the reality is a lot of our stuff just kind of plodded along. Yeah. No big, huge detractors. Small caps, you're gonna have your big swings, but in general, obviously that's working. So the key is quality stocks, and then on the bond side, basically sticking, kind of that quality again. Yeah. Government obligations, basically short-term treasuries or intermediate-term treasuries, and then for where taxes make sense, the municipal space is really what kind of keeping it simple is the key. We have some gold exposure, we have some commodity exposure, not a lot, but we want to keep it simple, quality going into this last phase of the economic cycle.
Yeah, good. Well, thanks, Kelly. Kelly, thanks.
No problem.
Awesome stuff. Cameron, thank you.
Good to be here.
Yeah, thank you, everybody. We're going to continue to do this. We think this is a great way for us to get our message out, and we appreciate your time. We appreciate the fact that you trust us with your assets. You trust us with your relationship, and I think the reality is we're all really honored to be in that situation to be your trusted advisors here at Ellsworth. So with that, we'll see you guys here in April. It'll be here before we know it. And have a great month, everybody. And we'll talk to you soon. Thank you.
Thank you.